Have you ever wondered how investment works? It's like planting a seed, watering it, and watching it grow into a tree that bears fruit. But instead of seeds, we're talking about money. You plant your money in different investment avenues and watch it grow over time. One of these avenues is securities. Picture this: securities are like movie tickets. Just like a movie ticket represents a seat in the theater, a security represents a financial value. It could be a share of a company, a government bond, or a piece of a mutual fund. When you buy a security, you're buying a piece of a financial pie, hoping that the slice you bought will be worth more in the future. Investing in securities is a way for you to grow your wealth. It's all about taking calculated risks to increase your financial security. Now that we've grasped the basics, it's time to dive deeper. Ever heard of a primary market or an IPO? Well, let's dive right in. The primary market is the arena where new securities are born. It's like the maternity ward for stocks and bonds. Here, companies issue new securities to raise funds for various purposes, like expanding operations or paying off debt. Now, let's talk about IPOs, short for Initial Public Offerings. This is the debut of a company's stock on the stock exchange. It's like the coming out party for companies, where they invite the public to buy their shares for the first time. During an IPO, you're not buying from another investor, but directly from the company itself. The money you pay goes straight into the company's coffers, helping it grow and prosper. And that, in a nutshell, is the primary market. With IPOs, you're buying directly from the company. But what if you want to buy from other investors? Welcome to the secondary market. This financial playground is where investors trade securities they already own. Imagine it as a bustling marketplace filled with buyers and sellers, all looking to make a deal. Here, stocks, bonds, options, and other types of securities change hands, but not from the issuing companies themselves. Instead, they're traded between investors, just like you and me. This dynamic exchange is what keeps the financial world spinning. But how do you manage all these securities? Enter the portfolio and diversification. Picture your investment journey as a grand expedition. Your portfolio is your backpack, carrying all the different investments you've picked up along your journey. Now, you wouldn't pack your bag with just one kind of item, would you? That's where diversification comes in. Diversification is essentially not putting all your eggs in one basket. It means spreading your investments across different asset classes like stocks, bonds, and commodities. This way, if one sector or asset class takes a hit, you won't lose everything. The beauty of diversification lies in its ability to balance risk and reward. A well-diversified portfolio reduces the potential for massive losses and can help generate more stable returns. So by diversifying, you're not just hoping for the best, you're strategically distributing your investments to weather financial storms. And that's the power of a diversified portfolio. It's like a safety net for your expedition. So we have our diversified portfolio. What's next? Let's explore derivatives, depositories, custodian, and mutual funds. Starting with derivatives, these are financial contracts that derive their value from an underlying asset. They can be stocks, bonds, commodities, currencies, interest rates, or even market indexes. Derivatives can provide leverage, meaning they allow you to potentially achieve higher returns from a smaller initial investment. But remember, with higher potential returns come higher risks. Next up, we have depositories. Think of a depository as a bank for securities. It's an institution that holds securities like shares, bonds, and mutual funds, making the trading process smooth and efficient. Then we have custodians. Custodians are financial institutions that safeguard a firm's or individual's financial assets to minimize the risk of theft or loss. They can also handle other tasks like account administration, transaction settlements, and tax support. Finally, let's talk about mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers. Mutual funds can be a great starting point for beginners as they offer diversification and professional management at a relatively low cost. And there you have it, a basic introduction to the world of investments.